In this lesson, we will discuss the inventory estimation methods that can be used when we are unable to take a physical count. So what are some examples of when we might use an inventory estimation method? Let's take an example. What if your inventory has been lost, stolen, or destroyed? For example, back in 2011 in Hershey, Pennsylvania, we had a severe flood that came through. It caused about a $15 million damage. We lost quite a bit of our inventory during that flood. Second method might be the interim reporting. If we do quarterly reporting, our company might want to avoid the expense of having a physical inventory count taking, because there quite honestly is an expense to having an outside firm come in and doing that physical count. And our third concept would be auditor testing, whether it's internal or external auditor testing. They're going to test the overall reasonableness of the inventory on the balance sheet. So basically we have two methods of estimation. First, we have the gross profit or gross margin method, which basically uses a historical gross profit margin to obtain a cost of goods sold estimate, which then allows us to get to our ending inventory on the balance sheet. Second, we have the retail inventory method, which uses a much more current cost to retail percentage based on those current relationships between cost and selling price. So first of all, let's take a look at the gross profit method. This is not acceptable per GAAP, mainly because it's too much of a heavy reliance on those historical gross profit margin estimates. In this scenario, we look at our beginning inventory plus our purchases, which we know is goods available for sale, or GAFS. If you take the goods available for sale minus our COGS, we get to our ending inventory on the balance sheet. Keep in mind that our COGS is basically our sales times the 1 minus the gross profit percentage. Please remember, this method only includes an estimate because it's only as good as the reliability of that gross profit margin ratio. Let's review an example of this with the gross profit method. Let's say you have a horrific warehouse fire where the following key data: your beginning inventory was $600,000, your purchases up to the fire were $1.5 million, your net sales up to the fire were $2 million, and your gross profit margin ratio over the past couple years has been 40%. So based on this above data, what's the best estimate of our inventory at the time of the fire? I'm going to give you a minute to determine this value based on those past gross profit margins. Let's see how you made out on this question. Let's review this gross profit method a little bit further. We know the formula: beginning inventory plus purchases minus COGS gets us to ending inventory. If we take the $600,000 plus the $1.5 million minus our COGS, we'll get to our ending inventory. The COGS in this case are the $2 million in sales that we had times the 1 minus the gross profit margin, which gives us a COGS of $1.2 million. Thus, subtracting the 1.2 from the 2.1 million, our ending inventory on our balance sheet, the loss we actually had, we might have to file an insurance claim for that, was $900,000. Under our second method, which is the retail inventory method, keep in mind this one is acceptable per GAAP for our audited financial statements at year end. As previously described, this method uses that very important cost to retail percentage relationship based on the current relation between cost and selling price. This is much more accurate than the gross profit method, as it's based on a current cost to retail percentage. This method is used by many high volume retailers such as Walmart and Macy's, who sell many different items typically at low unit prices. So let's look a little further at this retail inventory method. We take our ending inventory at retail, which is your goods available for sale minus our sales amount. Then we look at that all important cost to retail percentage, which is equal to your goods available for sale at cost divided by your goods available for sale at retail. Then you go on and calculate your inventory at cost by taking that amount at retail times that percentage you just calculated. That'll get you the amount you have to put on your balance sheet in your year-end financials. So let's review a retail method example with the following key data. Let's say your goods available for sale at cost are $300,000. Your goods available for sale at retail, what you're charging your customers, is $500,000 or $500,000. Based on this above data, what would be the best estimate of our ending inventory and our COGS, assuming sales level of $400,000? I'm going to give you several minutes to work on this retail method, and then let's review the calculation together. Okay, let's review this retail method solution a little bit further. We do the math on the cost of retail percentage, the $300,000 divided by the $500,000, which gets us to a percentage of 60%. Our ending inventory at retail is $500,000 minus the $400,000, or $100,000 left. If we then multiply that times the 60% relationship, we get our ending inventory at cost at $60,000. To figure out the COGS, or the cost of goods sold, it'd be the $300,000 that we had in goods available for sale minus that $60,000 pushes out $240,000 into our income statement. Hopefully the two methods make a little bit more sense now after these examples we ran through in the calculations.